Everyone, this is Tony Marino with Guild Mortgage. We have a great class today with Glenn Marino as guest speaker. We are going to be discussing the new IHDA program, um, Access Home for First Time Homebuyers. This program gives the buyer 6% of the purchase price up to 15,000. It's deferred. We'll go over the income limits, debt to income ratio, what they need to qualify for this program. So from there, I will throw it over to Glenn.
Well, thanks, Tony. You and I have talked, and this is a real exciting program. I mean, this is something that is going to change the landscape for first-time home buyers, as well as, we're going to go over some of the down payment assistance programs that exist for existing homeowners. This new program is just an add-on. There were three previously, and now this is a fourth one. So we're going to cover all four of them. So without further ado, let's get over to our PowerPoint. Let's share the screen and we will get to work on our presentation here. All right. Let's start it from the beginning. Well, as Tony mentioned, we're going to talk about, did homeownership just get easier? We're going to look at some of the proposals that the current administration is also providing for home buyers to make housing more affordable in the United States. As many people know, with the rise up of interest rates over the last several years, as well as prices going up, meaning that there's less inventory in the marketplace. When there's less inventory, prices get bid up. And it's made housing really unaffordable or unattainable for many people. And we're going to talk about what's bringing that back into reach. And then, like Tony said, we're going to talk about the new Access Home Down Payment Assistance Program, giving $15,000 worth of down payment or closing cost relief. So without further ado, let's talk about Tony for a second. He is the branch manager for the Marino team in Naperville, Illinois, for Guild Mortgage. He's been a loan originator, and he's been licensed and is licensed in Illinois, Colorado, and Florida. He specializes in getting people into homeownership using down payment assistance. He uses education to help people understand how they can become homeowners and own a part of the American dream. And he does provide one-on-one consultation to correct or repair a borrower's credit to make them home purchasing ready. You'll see what credit scores people need to be eligible for these programs, and Tony can help get them there if they're not there already. The American dream. Homeownership is still the American dream, and buying a home can be an exciting and intimidating process. I believe in the American dream, and I feel most people still do, but they're unsure as to whether it's achievable anymore with these high interest rates. This webinar will provide you with the information that will help your clients qualify for one of the down payment assistance programs, especially this new Access Home Down Payment Assistance Program. This helps clients dream of home ownership. Why do people seek the American dream? Well, they need or want to become a homeowner. Isn't that the American dream? Yeah, but there's too much misinformation out there. Do I really need 20% as a down payment? People don't realize that, you don't need 20%. There's many programs out there that are as low as 3%, 3.5% that will get them into a house. They need to learn to set aside their lack of confidence. It's self-defeating because they say, well, many think that they are years away from owning a home. 50% of the renters think they can't afford the down payment. However, they have the financial means to maintain a monthly mortgage payment that's about what they pay in rent. So what they pay in rent, they could be paying in a mortgage, but they just don't have the proper structure to go about purchasing a $400,000 home. There are many tiers of financial assistance, meaning down payment assistance, closing cost assistance that's available to home buyers. That's a great reason to be seeking the American dream. The American dream should be sought after because it enhances the quality of life. It's your own backyard. You got your pets in the backyard. Your children can play there. It helps individuals with wealth building and equity appreciation. I mean, it's an asset. If you rent, there's nothing as you pay the rent. You're only enhancing the equity of your landlord. If you're paying a mortgage payment, you're increasing the equity every single month as you pay down the loan and the property increases in value. So, what are the advantages of home ownership? Well, it's a place of your own versus renting or living with your parents. It's a sense of independence. It's a stable housing cost when you own versus rising rental costs. As we mentioned before, it builds equity, which builds wealth. Homeowners down here, homeowners that are people that own homes are 45 times greater is their net worth than that of a renter. You can deduct up to $40,000. This is very important. You can deduct up to $40,400 in state and local taxes on your federal income tax return. This includes the mortgage interest. This includes your real estate taxes. So no longer is it $10,000, it's going up to $40,400. You can borrow against the equity you build in your home or convert it into cash later when you retire. This leads into when you get to be 62 or older, when you're owning a home and it's mortgage free, you can take all that equity and turn it into a reverse mortgage and have it pay you on a monthly basis. If homeownership is so valuable, what is being proposed to make real estate more affordable? What's being proposed before the House, the Senate, and the President of the United States? Well, some of the key proposals are, and this one's a big one, the first one, the investor restrictions. President Trump has signed an executive order that targets large institutional investors. That means Wall Street. That means all these private equity firms on Wall Street, specifically those that own over 100 homes, from buying additional single-family homes. When they buy up single-family homes, what they're doing is they're fixing them up and they're putting renters in there. And when they buy up homes, they're taking the inventory out of the market, which then makes it more difficult for you, me, and other individuals who want to become a homeowner. We're finding that not only are we bidding on a house, but there's 10 more people because the inventory is much smaller, the pool is smaller, and the buyer pool is much bigger. Another thing that's happening is that they're looking at mortgage rate reductions. The administration has directed Fannie Mae and Freddie Mac, those are the two that purchase almost 100% of the conventional loans out there. They're to purchase $200 billion in mortgage-backed securities to push down borrowing costs. When the U.S. Treasury Department does this, you're going to see interest rates drop even further. Right now, Tony, would say that interest rates have just started to hover under 6%. So this would even bring them down further if this takes place. There's also a 50-year mortgage. It's being proposed to introduce 50-year mortgages to lower monthly payments for borrowers, to going from 30 years fixed up to 50 years fixed. Another thing that's being proposed is regulatory changes. The administration has emphasized cutting the red tape and removing the affirmatively furthering fair housing rule to streamline local housing development. Again, how do you get more housing into, if our pool of houses available for purchase is smaller, we need to make that pool bigger. You need builders, you need developers to build more houses. So they're reducing the amount of red tape and how much housing that they build. It has to be for certain income levels. They're getting rid of a lot of the red tape, making it easier for developers to build more single-family homes. Immigration policy. The administration has barred undocumented immigrants from accessing taxpayer-backed mortgages. What are taxpayer-backed mortgages? Well, that's going to be your FHAs. That's going to be your VA for veterans. So unless you're a U.S. citizen, these loan programs are going to be only available for those who have served, who are U.S. citizens. FHA will be available for U.S. citizens. Here's another great one, the First Look program. They're expanding programs that give individual buyers, you and me, and nonprofits priority to purchase foreclosed property. This is from HUD. When HUD forecloses, let's say on an FHA loan, it's now, when it puts it back out into the marketplace to be purchased, The first lookers are going to be individual buyers. So that's again a great opportunity, for people who are looking to become homeowners to be one of the first looks at buying a home from HUD. And down payment assistance. There's proposals to allow individuals to use funds from their retirement accounts. What's a retirement account? A 401k. Or your college savings plans, your 529 plans for home down payments without an early withdrawal penalty. If you withdraw money from your retirement plans before you're 59 and a half, you're going to get hit with a 10% penalty. They're proposing that you can use, again, a lot of people have seen their 401ks grow as the stock market has gone up, up, and up. And now what you could do is use some of that money that's in your 401k, withdraw it for down payment for closing costs if you're in the marketplace to purchase a home. So let's look at new and old down payment assistance. Who can use down payment assistance? Well, renters, first-time homebuyers, existing homeowners, your sons, your daughters, the millennials, Gen Zs. My daughter, two of my daughters have used down payment assistance programs when they became first-time homebuyers. So again, it may not be for you individually, but maybe you have a son, maybe you have a daughter, maybe you have an aunt, a niece, a nephew that could use these programs. So pay attention, lean in here, and learn about what these programs can do for people that are looking to become buyers. Family members that dream of home ownership, just as we talked about. It could be your son, your daughter, your nephew, your niece. Friends, you're always talking with friends. You're going to dinner, you're having a drink with them, and you're talking about, some of them are still renters or they're still living with parents. This is a perfect opportunity to bring up this program, especially this AccessHome program for $15,000. Anyone who thinks they cannot buy a home because they did not save enough money, well, if they've got enough money for their first month's rent and security deposit, isn't that what all landlords require when you rent an apartment? First month's rent, security deposit. If it's $3,000 in rent, it's $3,000 in security deposit. They've got $6,000. Perhaps that's all they need in order to become a homeowner, and we're going to show you that shortly. Anyone who's interested in buying a home for less than 1 month's rent and security deposit, we just talked about that. All your renters have first month's rent and security deposit. If they have that, you need to show them this presentation as to how they can use that to become a homeowner instead of being a renter. Buying a home is a huge step. Buying a home doesn't have to be that challenging. If they're just missing the down payment, they can afford the monthly payment. They can, what they're paying in rent, they could afford, they could pay in a mortgage payment, but they just don't have the savings for the down payment. This program is for them. So what if you and I can help with the missing down payment? What should we be doing? Be an educator. There's going to be a flyer at the end of this that you should be handing out to people, letting them know that there's $15,000 available to them to become a home owner. There is no monthly, there's no interest on it. There is no monthly repayment. The only time you repay the $15,000 is when you sell the house 10, 15, 20 years down the road. It helps an individual overcome a financial barrier to home ownership. Financial assistance is down payment and closing cost assistance. And Tony Marino, the Marino team, can provide you with access to the Illinois Housing Development Authority program, the tier of them. And we'll go through them more slowly in a little bit, but they start out as low as $6,000 as a grant, $7,500 as a zero interest loan with no monthly payment, very similar to the $15,000. The $10,000 is zero interest loan, but it does require a monthly principal repayment of $83.33. And now, last but not least, the new $15,000 program that's going to be zero interest, zero payments, repayable only when you sell or refinance the house. So get your co-branded flyer and hand them out to family, to friends, to prospects, so that they become aware that there's this new program and that it's going to make homeownership now even easier. So what are the IHDA down payment assistance programs? We talked a little bit about them, so let's take a quick look at them. Here's the Access program. As Tony mentioned, it's 6% of the purchase price, up to a maximum of $15,000. So again, you'll easily get to that $15,000 mark, if you're buying a home, more more than 100 and some $1,000. It's good for 30 years, meaning that you get the money, you don't have to pay it back for 30 years, or the lesser of, or if you sell the house or if you refinance the house. And it can be used for the down payment and the closing costs. The next one is the repayable. This is the $10,000 program. It's a 10-year repayable. You divide 120, that's 120 months or 120 payments is 10 years. You divide that into 10,000, that's $83.33 a month. The next one is for $7,500. It's 5% of the purchase price. Again, it's for 30 years. It's very similar to the $15,000 program because it's zero interest, zero monthly payments, and you don't pay it back until such time as 30 years has gone by or you sell or refinance the house. And then lastly is the 4% of purchase price, or the $6,000 program. And it's what they call a forgivable grant, a forgivable loan. So you get $6,000, and over 10 years, again, remember 10 years times 12 is 120 payments. So every month, 1/120th of the 6,000 is forgiven. So if you stay in the house for 10 years, you pay nothing back. If you stayed in the house for 5 years, so 50% of the time has gone by, you would only owe back $3,000 when you sell or refinance the house. Great programs, so let's take a deeper dive. So the new AccessHome Loan Program. Are you ready to buy? We offer up to $15,000 in assistance for qualified home buyers. The eligibility requirements include that it's available for first-time and non-first-time home buyers within IHDA's income and purchase limitations. But let's be real careful. It's really a first-time home buyer program, this access, because non-first-time home buyers, people that own existing homes, they're limited only to veterans, which God bless them. Thank every veteran for their service whenever you see them, and those that are purchasing in a targeted area. So if you're in a certain targeted area, and we won't go into which ones are, but you can always check with Tony if you're buying in a targeted area. But they can use this program, in fact, if they are not first-time home buyers. But let's focus on as if this is a first-time home buyer program, because that's what 99% of the people are going to use this. You must purchase a 1 or 2 unit single-family home within the state of Illinois. 3 and 4 units are not eligible. The borrower must occupy it as their primary residence, and no non-occupant co-borrowers are allowed. What does that mean? Non-occupant. If Glenn Marino, myself, if I'm helping my daughter to buy a home under other programs other than this, I can be considered a non-occupant co-borrower, and they can use my credit, my income. Can't use a non-occupant. I don't plan to occupy it if I'm helping my daughter. She will be occupying it. You can use that with conventional loans and loans that are not involving this Access Home or any of the down payment assistance programs. So again, borrower must occupy it as their primary residence. Keep that in mind. It's not for investment properties. It's not for vacation homes. And it's a 30-year fixed rate for a Fannie Mae, a Freddie Mac conventional loan, for FHA, VA, or USDA. We'll go through the income and property limits in a second on another slide. The minimum credit score is 640. Well, that's not the hardest credit score to get. So a lot of people that friends, family, yourself, are walking around with at least a 640 credit score. And remember what I said about Tony? If they don't have a 640, he's got tools to help you get your score up to 640. If your debt to income ratio, debts, meaning your housing payment plus all your other monthly payments for credit cards, student loans, automobile loans, your debt is the numerator, your gross income is the denominator. If that ratio is between 4501 to 50, your credit score goes up to 680 for FHA, VA, and USDA. The maximum debt to income ratio, which we just talked about, is 50%. The borrower must contribute 1% of the purchase price or $1,000 if 1% happens to be less than $1,000. So the minimum is $1,000. but most people that we see are buying a home greater than $100,000 because 100,000, 1% is $1,000. Most people we see are buying a home for more than 100,000. So they're putting in 1% of the purchase price. Homeownership counseling is required, can be done through your computer online. Tony can give you the link and you'll go off and do that. And then this program, the $15,000, is 6% of the purchase price, up to $15,000 in down payment and closing cost assistance. It's a 30-year second mortgage note with zero interest. That's nice. Zero, no monthly payments. That's even better. And it's only repayable upon maturity, meaning 30 years from now. Refinance, if you decide to refinance, and you're about to see that this program gives you a below market interest rate. This is going to excite the daylights out of a lot of people when you see the below market interest rate. So whichever comes first, refinance, sale, or maturity. So what about these IHDA interest rates that we talked about, this below market? Well, there's only one interest rate that's offered each day by IHDA. So again, if you talk to Tony and you get an interest rate quote, he's getting it from IHDA. It's not like you can shop around and go, well, let me see. I'm going to go to Bank of America, Wells Fargo. I'm going to go to 3 other places. Everybody who happens to be a certified IHDA lender, and not all lenders are certified IHDA lenders, but the certified IHDA lenders only have one rate. Go with the individual such as Tony, where he can give you good education, help you work on your credit, and he can show you how you can buy a home for as little as 1% of the purchase price. So the interest rate is the rate for the borrower's first mortgage for their FHA, VA, USDA, or conventional. So where are the rates as of Friday? As of last Friday, look at this. Below market, if you do an FHA loan using this $15,000 program, you get a rate of 5.625. That's great. It's phenomenal. The forgivable is the $6,000 program. The rate is 6.25. The deferred is that $7,500 where it's deferred for 30. It's just like the 15,000. It's deferred until maturity, 30 years from now, or when they sell the house, or when they refinance the loan. That's 5.875. Not bad at all. And then they've got the repayable, which is the $10,000 program, and that is 5.875. Remember, the 10,000 is a repayable principal only. It's a zero interest loan, but you must make monthly payments of $83.33 a month. So what are the income and the purchase limits? I use DuPage County, but DuPage is in what we call the collar counties. This is going to be good for Cook, Will, McHenry. So all the collar counties around DuPage are going to fall into these income limits and purchase limits. So let's first do what I call the limits for non-Access Home. Remember, Access Home is only the $15,000 program, only for first-time homebuyers largely. All the other programs, the 6,000, the 7,500, and the 10,000 tiers, they're good for first-time and existing homeowners. So right now, the non-Access Home programs, the 6,000 to 10,000, the income limit is $143,880. If you are a first-time home buyer, the income is almost $120,000, $119,900. Wouldn't I gotta believe, and again, if you have 3+ persons in the household, it goes all the way up to 130, almost 138,000. But I gotta believe, as we all sit here, there's many people we know, family, friends, prospects, that earn at least, that their income is under these numbers, under 143, under 120,000, making them eligible for using these funds that don't require much of a repayment unless you take the 10,000 where it requires $83.33. Sticking with, though, the home access program, I can't have an income greater than 120,000 for the borrower. And let's make sure we understand this. If Glenn and Rose are going to own this home, but they qualify just on Glenn's income, that they don't need Rose to be a borrower on the loan application. So you have a single borrower. These income limits are not household. They don't take Glenn's income and Rose's income. And if there's anybody over 18 years of age, son, daughter living at home, add up all the household income. No, 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 no. That's not how it works. It's strictly who's on the loan application. If Glenn's income alone is under 120,000 and his income qualifies him to purchase the home that they're looking at, that's all that matters. Doesn't matter what the rest of the household makes as far as income. So it's a borrower income limitation, not a household. So walk away with that concept. Purchase limit. I don't know about you guys, but if I'm a first, if even if I wasn't a first-time home buyer, I can go up to $664,000 on a purchase. I can go almost up to $800,000 on a 2-unit. Those are big numbers. I don't think I'm going to breach those numbers if I'm trying to use this program and trying to buy a house. If I'm a first-time home buyer and I want to use this AccessHome program, I can go up to $544,000 in a purchase. That's a big house for a first-time home buyer. And if I'm buying a 2-unit, it's almost $700,000, $696,816. So great limits, great, great income. It brings a whole bunch of people that we know into this program and helping them become homeowners because they're going to get $15,000 worth of down payment and closing cost assistance. So how can we structure a home purchase using this new AccessHome Loan Program? Well, let's look at the cash needed to purchase. Let's look at what we call the 3 buckets of cash. So here's an example of a $400,000 home being purchased. We're going to use FHA, which is only a 3.5% down payment on line 2. The assistance program line 3 is $15,000. The average closing costs on line 4 are $5,500. IHDA requires that they charge a 1% of the loan amount as an origination fee. And then there's the buyer's agent fee of $10,000, say 2.5% of the purchase price. So now let's compare. They've got to make a decision. Do we stay a renter or do we buy a house? I'm looking at a $400,000 home. I can rent it or I can buy it. So if I'm going to rent this 3 or 4 bedroom home for $400,000, I'm going to pay probably about $3,500 for the first month's rent and security deposit, or I'm going to have in the bank $7,000. So I got $7,000. So now I'm going to look over here at the purchase, and there's 3 buckets: bucket 1, bucket 2, bucket 3. Bucket 1 is down payment. We said the down payment is 3.5%. 3.5% of $400,000 is $14,000. Okay, cool. Who pays? Every bucket you have to ask who pays. Well, remember we said the buyer has to come up with 1% of the purchase price. 1% of $400,000 is $4,000. Got it. Check it. Then I'm going to take, of my $15,000 in down payment assistance, I'm going to take $10,000 and use that. So now I've got 10 and 4 is 14. Boom. I got all the money I need for bucket 1. Move on to bucket 2, closing costs. Okay. The closing costs are $19,380. That is this $10,000, the $3,880, and the $5,500. So again, who pays? Well, let's start down here. The seller, typically the way the contracts are written these days, the seller pays the buyer's agent fee. So we got the seller paying this $10,000. Not a problem. What do we have remaining of our down payment assistance? We use $10,000 up here in bucket 1 of $15,000. $10,000 from $15,000 means I have $5,000 left over. So I have $5,000 in down payment assistance. So what's left is $4,380. Well, again, that can be paid by the borrower. It also can be negotiated that the seller pays that, or they can go into their 401k. Remember we said how these 401ks have been growing and growing with the stock market hitting all-time highs? Well, maybe they ought to, if they take out a 401k loan, that's a loan to themselves. They can put, they can borrow $4,400 from their 401k, and now they've got all the money that they need, the $19,380. Let's go to bucket number 3, prepaids, escrows. Well, that is the prepaid interest that you pay from the date of the closing to the end of the month, plus it's the escrows for real estate taxes and homeowners insurance. To make it easy, in the state of Illinois, we pay our taxes in arrears, which means we're in the year 2026, correct? That means we're paying in arrears going back. We're paying 2025's real estate taxes. So when we are a buyer, if we're buying a home in April 30th, the first 4 months of 2026, January, February, March, April, the sellers lived in that house. The seller has to give our buyer a credit. Just so you know, the credit is always greater than what the lender wants you to set up in the escrow. This actually could be a negative number in bucket 3, but let's just say it's 0 for purpose of discussion, because the credit from the seller for the real estate tax credit for the months that they lived in it in the current year more than offset what the lender is going to ask them to put aside for real estate taxes and homeowner insurance in the future. So if you look at the yellows, we got to come up with $4,000 in bucket 1, theoretically $4,380, or it could be 0 if the seller pays it, or if we get a 401k loan, or if we go to mom and dad and say, Mom and Dad, how much do you love me? Are you willing to give me a gift for $4,300? So our number down here is $8,380 if they had to pay the $4,380, or if the seller paid the closing costs, or if they got a 401k loan, or if they got a gift, it's only $4,000 that they come up with. So if you were going to be on the threshold of making a decision, do I rent a $400,000 home or do I buy it? Do I come up with $7,000 and own nothing? Or do I come up with $8,300 or $4,000, depending upon how the negotiations go with sellers, with my 401k, with my mom and dad? I think it's pretty easy to say, if I was that close to the $7,000 I got in the bank, I'd much rather own the house than rent the house. And this is very, very important. I mean, it's something that you need to walk through with Tony to make sure that your clients, or that you as an individual, if you're looking to buy, that you understand how you're going to satisfy each of these buckets, bucket 1, 2, and 3, and that you're really coming up with little money other than what you would have come up with had you been a renter. So what's your housing payment? You're buying, you decided, you know what? That cash due at closing, $4,000 or $8,300, I can come up with it. So what is my payment now on a $400,000 home? Well, with FHA, your loan amount is going to be $392,755. If you're using the $15,000 zero interest, zero payment loan, remember the below market rate? 5.625. Isn't that a nice number? Principal and interest is going to be $2,262. There is no down payment assistance payment. You don't pay anything until you sell the house, refinance the house, or 30 years later when it matures. Real estate taxes, $750 a month. Homeowners insurance, $208 a month. Private mortgage insurance, because you're not putting 20% down, $177 a month. You add this up, you got $3,397 is your mortgage payment. Well, wait a minute. Your rent is $3,500? Even if your rent was $3,000, wouldn't you look over here and say, $3,397 and I own the house every single month? You'd be saying, this makes total sense to me to be sitting down with Tony, structuring a deal with him and the realtor to make sure that I can become a homeowner and use this below market, zero interest loan that's going to get me into the house. Again, it assumes a 5.625 interest rates on an FHA 30-year fixed. And what if this was a 2-flat? What if the realtor and Tony were helping you buy a 2-flat? You would subtract what are you going to get for rent for one of your units? If it's a 2-flat, $2,000. All of a sudden, you subtract 2,000 from 3,397, and your mortgage payment is 1,397. Isn't that a nice thought to be carrying around? So 1 unit or 2 units are eligible for this program. So let's summarize the 3 buckets of cash. Who pays? In down payment, who pays? Well, you can pay the down payment, or you can have IDA do it. Remember, typically you got to come up with at least 1%. On conventional loans with high credit scores, it could be as low as 3%. On conventional loans with lower credit scores, it could be 5%. FHAs with credit scores of 680 plus, you can get 3.5%. But look at this, 1% is all you have to come up with. That's your share if you use the IDA down payment assistance. If you use the 10,000, the 7,500, the 6,000, or now the new $15,000 program, 1%. Closing costs, you have to ask who pays. It's approximately $5,500 plus you have an additional 1% origination fee that IDA charges. Well, who pays it? Again, you, the borrower, you can pay it, or you can have IDA pay it. In our example, when we were looking at it, IDA was paying $5,000 of the closing costs, and we still needed something like $4,300. Well, the realtor can negotiate to have the seller pay. He can either upfront, when you make the offer, you can offer that the seller has to pay $4,400 worth of closing costs, or if that's not something the seller is willing to do, after you make the offer, you can always have your realtor go back to the seller and say, my client wants to pay more. He wants to pay $4,400 in what I've written here, $5,500 more for the seller's house. And they all look and go, this person must be crazy. They just made us an offer. Now they want to pay us more. However, provided the seller pays $5,500 of your closing costs. The addition, two things to note here. The additional monthly payment for bumping the price up $5,500 is going to be very small increase in your monthly mortgage payment. But it's going to mean a lot to you if the seller comes up with that $4,300 or $5,500 that completes all the funds that are needed for your closing cost bucket number 2. And lastly, if you do use this, the realtor has to give you confidence that the house that you made an offer on, say you made an offer at $350,000, and now you're bumping it up $5,000. So now it's $355,000. The realtor's got to be able to show you other comparables in the marketplace, in the neighborhood, that your home that you're purchasing will appraise for at least the increased $5,000. And lastly, your lender can pay for some of these closing costs, bucket number 2, when it's a non-IDA loan, just an FYI. So how much of your own funds were used for closing costs? In many cases, it's only 1% of the 1% of, I shouldn't say it. In many cases, it's 0 is what you're coming out of pocket for on bucket number 2. Bucket number 3, prepaids, escrows. Remember, prepaids are the interest you pay from the date of closing to the end of the month. Therefore, most purchases on homes, they end up taking place towards the end of the month because the number of days is only 1, 2, 3 days. And so you have very little in this prepaid interest bucket. Reserves or escrows are escrows for real estate taxes and homeowners. You're typically going to put 2 months of homeowners, 2 to 8 months worth of real estate taxes. But because Illinois, you pay real estate taxes in arrears, meaning that in 2026, we're paying the 2025 taxes. So the seller, for the number of months that he lives in the house in 2026, must give you a seller credit. In red, seller credit for real estate taxes while the seller lived in the home in 2026. This bucket is always 0 because the credit is greater than what's needed to set up in these escrows and prepaid interest. So summarizing the 3 buckets of cash, how much of your own funds is needed? Bucket 1, down payment. IDA says you have to put in minimally 1%. Bucket number 2 could be 0 with IDA paying it and or the seller paying it, or your 401k paying it, or getting a gift from mom and dad. Bucket number 3, escrows, is 0 with the seller credit for real estate taxes. So again, 1%, 0, and 0. Sounds like a great plan to me. So what are your clients waiting for? What are you waiting for? Take some action. Now that you've reviewed how little cash is needed, what's the next step? Educate, educate, educate your prospects. Or if you're not a prospect, educate yourself. You need to be able to know that these programs exist and that with the help of Tony Marino, he can show you how you can buy a home for as little as 1% of the purchase price. Give them a co-branded flyer. We're going to show you at the end a flyer that's available to you through Tony. Get as many as you like, print them, hand them out to people, let them know that there's you as an educating realtor have a program that's going to give them $15,000 with no monthly repayment. Provide a monthly homebuyer seminar. This, I can't emphasize this enough. This type of a program should be put into a homebuyer seminar sponsored by the realtor. And all you got to do is give Tony 6 prospects, whatever the name is. And it'll go out from you inviting them. We'll give you the Zoom link. We'll give you the registration link. Tony and myself will be the speakers for the seminar. And you're going to give people a lot of great education. They love to know that it came from you, the realtor, and with your team, the lender. Provide monthly home buyer seminars. It's just this is a great way to get it out there. You meet people all the time. You've got their emails. Invite them to an educational seminar where they can get $15,000 in below market rate, no repayment for 30 years. And it could be structured where they pay as little as their first month's rent and security deposit is all they would need to be a buyer. Your goal, your homework today, is to get clients pre-approved for free with Tony. If you think you got people that are on the fence about being a homeowner, do a 3-way conversation with Tony. Work through this PowerPoint with them. Work on the Excel spreadsheet with the actual numbers that they're looking at. Give them a free credit report. If their credit isn't where it needs to be, let Tony rescore it if necessary. Assemble the necessary documents for a full application. Get an automated underwriting approval. Get a pre-approval letter from Tony. Now that you have a yes on a pre-approval letter, go shop for a home. Have fun with the realtor. And then review the action plan with Tony once you've settled on which house it is. But start hosting homebuyer seminars using Tony's Zoom software. You don't need Zoom. You don't need the software. You just need to pick up the phone, call Tony, and say, let's do a seminar next month. Here's 6 prospects. They're very interested in learning about this $15,000 program. So the Marino team wants to thank you. Our commitment is to get you people pre-approved in 24 hours, committed to financing the dream homes of clients, always being available for questions. And Tony can be reached at 847-804-1059 or tony.marino@guildmortgage.net. So check out the co-branded flyer. And then who wants a $15,000 co-branded flyer? Put your name in the chat box and we'll get it out to you. Let me show you what that's going to look like. The co-branded flyer. Looks like this. Your first steps toward your first home. New First Time Homebuyer Program. 6% of the purchase price, up to $15,000 maximum. Can be applied to down payment and closing costs. You can use Fannie Mae, Freddie Mac, FHA, VA, USDA. It says apply with one of the over 160 approved lenders. I'd say only apply to Tony, just one. He's the best. Main requirements, a 640 credit score. Max debt to income ratio is 50%. It can't exceed the income or purchase limits in the program. So by all means, get the flyer, get it into your hands, get it into your briefcase, and hand it out to everyone. Attach it to emails as you're conversing with people. Let them know that you've got down payment assistance up to $15,000. That if they have at least the first month's rent and a security deposit, they probably should become a homeowner. So with that, I'll I'll go back to the presentation and just ask, are there any comments, questions, or suggestions?